Welcome to the Opening Bell Report.
Usually, when we start one of these deep dives, we like to sort of ease into the water.
Right.
We set the scene, maybe talk about some broad macro trends, throw in a metaphor about the energy transition, warm things up.
Yeah, but today we really don't have that luxury.
We do not. Today we have to start with the elephant in the room.
Yes.
Or, maybe more accurately, the car crash in the room.
It really was a brutal week, wasn't it?
Yeah.
If you were watching the ticker, it didn't feel like a market correction. It felt like capitulation.
Brutal is putting it lightly. We are talking about EOS Energy, ticker symbol EOSE. If you glanced at your portfolio, or just the headlines recently, you saw a single day drop of 39.44%.
Ouch.
Yeah, landing right at $6.74.
That is almost 40% of the company's value just wiped out in a single trading session.
Right.
That's the kind of move that makes you check your internet connection,
Yeah.
just to see if the data is glitching.
Exactly. And on the surface, that screams disaster. It looks like a company that is just falling apart, failing to deliver, and frightening its investors into a mass exodus.
Yeah.
And this is exactly why we do these deep dives. We have a stack of analysis here that suggests something completely different is happening underneath that panic.
It's the classic wait a minute moment.
Yeah.
Because while the market is hyper-focused on a short-term earnings miss, which, look, we absolutely will get to.
You have to.
Right? You can't ignore a near billion-dollar loss figure.
Yeah.
But they seem to be completely ignoring a structural pivot that is honestly kind of mind-blowing.
Right. And that leads us to the headline statistic that nobody seems to be talking about while they're panic selling.
Let's hear it.
While the stock price was nosediving 40%, the actual business activity was doing the exact opposite.
You're talking about the revenue explosion.
A 632% year-over-year revenue increase.
It's a staggering number. It really is.
And our mission today is to reconcile these two realities for you. How can a company grow its revenue by over 600% and lose 40% of its stock value in 24 hours?
Right.
Is this a falling knife that you just shouldn't touch? Or is it a massive misunderstanding of how a manufacturing business actually scales?
That is the question. So let's look past the panic. Let's unpack the business mechanics, this technology mode everyone keeps mentioning, and figure out why the analysis report suggests this company might be scaling way faster than the market realizes.
Okay, let's unpack this. We have to start with the bull case simply because the number is so large it almost looks like a typo.
Yeah.
The revenue explosion. When we say 632%, break that down for us. Where is that actually coming from?
So it comes from a direct comparison of their fiscal years, and context is key here.
Okay.
If you look at fiscal year 2024, EOS Energy brought in $15.6 million.
Got it.
Now, for a grid-scale energy company, $15 million is, well, it's a pilot project.
Right.
It's a proof of concept. It's hello world.
It's a startup number, barely a blip on the radar.
Exactly. But fast forward to fiscal year 2025. That number hit $114.2 million.
Wow.
That is the 632% leap right there. They effectively went from a science project to a 9-figure revenue business in 12 months.
That is massive. Usually when we talk about high-growth tech stocks, we're excited about 50% growth.
Sure.
Or maybe doubling revenue. But 6x, that is rare air.
It is. And what's fascinating here is the nature of that growth. Sometimes companies have a weird year where they recognize a huge one-off payment.
Like selling off an asset or something.
Exactly. And it inflated the top line.
Right.
But this isn't that. This is product leaving the factory. This is actual batteries being shipped out the door.
And I noticed the analysis emphasizes sequential growth. This isn't just looking back at last year. It's looking at the immediate trajectory, quarter over quarter. Why does that matter so much?
Well, in manufacturing, sequential growth is the heartbeat. It tells you if the factory floor is actually working and if the supply chain is holding up.
Because it's physical.
Right. It's one thing to sell software. You just copy the code. But here, you have to physically build the thing. So look at Q3 to Q4. In Q3, they did $30.5 million.
Okay.
In Q4, they did $58.0 million.
So they almost doubled their revenue in just 3 months. That's a 90% jump.
A 90% sequential increase. That signals that their production lines, specifically what they call the Z3 automated line, aren't just running, they are ramping up significantly.
They're moving from figuring out how to build it to building it at speed.
Exactly.
To put that in perspective, the report compares this to some of the bigger players, like Fluence Energy, ticker FLNC. Now, Fluence is kind of the titan in this space right now, right?
Right. Fluence is the benchmark. But interestingly, Fluence recently posted a top-line miss, and their growth is visibly slowing down. Now, to be fair to Fluence, they are working from a much, much larger base. It is mathematically harder to double your size when you're already generating billions.
The law of large numbers.
Exactly.
It's harder to steer a cruise ship than a speedboat.
That's a good way to put it. But the trajectory difference is stark. EOS is climbing a vertical wall right now, while the incumbents are hiking a steep hill.
Yeah.
EOS is in that hyper-growth phase that investors usually drool over.
So we have this massive growth, but obviously you don't grow revenue like that unless someone is actually buying what you're selling.
Right.
And this brings us to the why. We need to talk about the product, because EOS isn't selling the same batteries that go into a Tesla.
No. And this is the most critical distinction for you to grasp. If you don't understand the difference in the tech, the rest of the numbers don't matter at all.
Okay, lay it out for us.
EOS operates in a sector called LDES, long duration energy storage.
Long duration. Define that for us. Are we talking about a battery that lasts a long time before it degrades, or?
Or a battery that discharges power for a long time.
Right.
Good clarification. We mean discharge duration. Generally, anything over 4 hours, extending up to 12 hours. And the report highlights a very specific booming driver for this demand.
Let me guess. AI data centers.
AI data centers.
Of course. It always comes back to AI these days. It feels like every deep dive we do eventually leads to AI.
It really does.
Mm-hmm.
But for a very physical reason here. This isn't just hype. AI chips. The NVIDIAs of the world are incredibly power hungry.
Yeah.
But more importantly, they are completely intolerant of interruption. Data centers need massive amounts of consistent, reliable power 24/7.
Right. You can't have ChatGPT or a medical AI diagnostic tool go offline just because the wind stopped blowing in Texas.
Or the sun went down in Nevada.
Exactly.
Renewables provide cheap power, but they're intermittent. The wind doesn't always blow, the sun definitely sets.
So the data centers need a buffer.
They need a bridge. And they need a bridge that lasts for hours, not just the few minutes it takes to spin up a gas generator. They need to smooth out the curve entirely.
Okay, so the demand is absolutely there. The world is hungry for power storage. But here's the question I keep asking myself.
Okay.
Why EOS? Why not just buy a shipping container full of standard lithium-ion batteries? We know those work. We have them in our phones, our laptops, our cars.
Right.
Why take a risk on something different?
This is where we get into the technology mode. EOS uses zinc halide chemistry.
Zinc halide.
Right. And there are two massive reasons why a corporate buyer, someone building $1 billion data center, would choose zinc over lithium, safety, and supply chain.
Let's tackle safety first, because we've all seen the headlines. E-bikes catching fire in apartments.
Tesla fires that take thousands of gallons of water to put out.
Exactly.
That is called thermal runaway. Lithium ion is incredibly energy dense, which is great for a car because you want it to be light. You want to go 0 to 60 fast. But that density comes with volatility. If a cell is punctured or overheats, it creates its own oxygen and burns violently. It's a chemical fire.
Now, imagine you are a risk manager for a massive tech company.
Right.
You've got a server farm with billions of dollars. Do you want to surround it with thousands of batteries that have a non-zero risk of effectively turning into bombs?
Probably not. And that is the EOS pitch. Zinc halide is aqueous. It's water-based.
Water-based.
It is non-flammable. You could practically shoot it with a gun and it won't explode. It just leaks.
It's just a puddle on the floor.
Exactly. The report emphasizes this as a huge selling point for corporate clients who are, by nature, very risk-averse. They want boring. They want safe.
It's peace of mind insurance. What about the second point, the supply chain?
It's at the geopolitical angle. Lithium is a nightmare right now.
Yeah.
Most of the processing happens in China. Prices fluctuate wildly based on trade wars and mining output. It's a strategic vulnerability.
So if you're building critical U.S. infrastructure, relying on a supply chain dominated by a geopolitical rival is, let's call it suboptimal.
Highly suboptimal. And zinc.
Zinc is boring.
Zinc is boring. And in supply chains, boring is beautiful. It's abundant. It's mined all over the world, including right here in North America.
Okay.
And EOS's technology is fully domestic. It is U.S.-based manufacturing using materials you can get easily.
That domestic angle seems huge, especially with the current political climate regarding manufacturing and energy independence.
It's not just a nice to have. It's a strategic asset. And we see validation of this from the U.S. government.
Yeah.
The report highlights the conditional loan facility from the Department of Energy, the DOE.
That's the $303.5 million figure, right?
That's the one. Now, we need to be clear, it is conditional. They haven't just been handed a blank check.
They have to meet milestones.
Exactly, to unlock that cash. But when the DOE commits over $300 million, even conditionally, they aren't throwing darts at a board. They perform immense due diligence.
So it's effectively a stamp of approval.
It's a signal that the U.S. government is betting on zinc halide to be a winner in the energy transition. They need a domestic alternative to lithium to secure the grid, and they think EOS might be the horse to back.
Okay, so let's pause and recap the bull case here because it is strong.
Very.
We have revenue up over 600%. We have a 90% jump in just the last quarter, proving the factory actually works. We have a safer water-based technology that uses common materials. And we have the U.S. government backing it with hundreds of millions of dollars.
It sounds like a slam dunk, doesn't it?
It really does. If I just told you that and didn't show you the stock chart, you'd assume the stock was up 50%, not down 40%.
Right.
So here's where it gets really interesting. We have to get real. We have to be the adults in the room and look at the ugly numbers.
Yeah.
Because you don't drop 40% for no reason. Why did the stock crash?
Candor is key here. We cannot ignore why the market freakout happened. It wasn't a hallucination. It starts with expectations. Wall Street is a game of expectations, and EOS played that game and lost.
They missed the target.
They missed it by a mile. Wall Street analysts had modeled Q4 revenue to be $93.36 million.
And they came in at
$58 million.
$58 million. Okay.
Right. So recall what we said earlier. $58 million was a huge growth over the previous quarter. It was a victory for the factory floor.
But a massive failure for the spreadsheet.
Exactly. That is a $35 million gap between what they promised or what the market hoped for and what they actually delivered.
In this market, if you miss the top line by 30%, you get taken out to the woodshed. There is no mercy.
None.
But it wasn't just the revenue miss, was it? The loss numbers were, well, eye-watering is the only word for it.
They were hard to look at. The analysis report notes a widened net loss of $969.6 million.
Almost $1 billion in losses.
Almost $1 billion. Now, we have to be fair, analysts here. There are non-cash items in there.
Like what?
Things like warrant revaluations,
Yeah.
accounting shifts involving the DOE loan issuance costs. It's not like they wrote a check for $1 billion and lost it in a casino.
Sure. But the headline number.
It is scary. And then you look at the cash burn, the operational burn rate.
The report says they were spending nearly $2 for every $1 they make.
Cash flow percentage of sales is at negative 191%. Basically, to sell a battery for $1, they're spending almost $3 in total costs and overhead.
Wow.
They're lighting cash on fire to grow.
Okay, so if I'm an investor, I see $1 billion loss and a massive cash burn, and I run for the hills. That explains the sell-off. It looks like they're bleeding out.
It absolutely explains the sell-off. Investors look at that burn rate and they ask, will you go bankrupt before you get big? It's a totally valid fear.
Right.
But, and here's where the deeper view comes in. We have to understand the economics of scaling heavy manufacturing.
Okay, walk us through that.
This isn't software. You can't just copy-paste code to sell more product. You have to build factories. You have to buy steel, zinc, plastic. You have to hire workers.
So you have massive upfront costs, what they call CapEx, before you see any return. You have to buy the cow before you can sell the milk.
Precisely. You burned cash to build the machine that eventually prints cash. And if you look closely at the data in the report, there is a nuanced counter-argument to the disaster narrative.
What was it?
You have to look at the margins, specifically the net profit margin percentage.
Okay, why does that give you hope?
In FY24, their net profit margin was negative 4,396%.
That is barely a real number. That's horrific. That means for every dollar they brought in, they lost $43.
It is bad. But in FY25, it improved to negative 849%.
Okay, negative 800 is still bad, but that is a massive improvement from negative 4,000.
Exactly. The hole is getting shallower. The absolute loss is huge because they are getting bigger factory, more staff. But the efficiency is improving dramatically because the revenue denominator, the top line, is skyrocketing.
Got it.
They are proving that as they scale, the unit economics get better. They just aren't profitable yet.
So it's a race against time and liquidity. Can they scale fast enough to become profitable before they run out of money?
That is the defining question. It is a race against the cash balance. And they are betting everything that they can cross the finish line before the tank runs dry.
Which brings us to the forecast. What is management saying about the finish line of this race? 2026 seems to be the magic year.
It is. Management has issued guidance for 2026 revenue to be between $300 million and $400 million.
So that would be another tripling or quadrupling from where they are now.
Right. If they hit $400 million, that 600% growth we saw this year starts to look like the beginning of a trend, not a fluke.
Yeah.
But the revenue isn't the most important number in the forecast. The holy grail here is profitability.
Specifically, gross margins.
Yes. Management is forecasting that they will reach positive gross margins in the second half of 2026.
Let's make sure everyone understands why that matters. We hear gross margin all the time, but for a manufacturing company, what is the shift that happens there?
It changes everything.
Yeah.
Right now, every battery they sell loses money on a unit basis.
Yeah.
They're essentially subsidizing their customers to gain market share and prove the tech.
Right.
Once you hit positive gross margins, every battery you sell contributes to paying off your overhead. It means the core business actually works. It means you are no longer selling dollars for 50 cents. You are selling 50 cents of materials for $1.
Once you cross that line, the company becomes self-sustaining. You stop bleeding.
Exactly. And once you stop bleeding, the stock price usually reacts violently to the upside. That is the moment the cash incinerator becomes a cash generator.
So the bet is, can they survive until the second half of 2026?
That is the bet. And despite the crash, despite the panic, the analysts who cover this stock seem to think the odds are better than the current price suggests.
The valuation gap. This was the most surprising part of the report for me. I assumed after a 40% drop, analysts would be slashing their targets.
The stock is trading at $6.74 right now. But the 12-month average price target from analysts, the consensus is $14.08.
So the experts are saying this stock should be more than double what it is today, even after factoring in the miss and the burn.
They are saying that the market has overreacted to the short-term pain and is undervaluing the long-term potential. If, and it's a big if, they hit those 2026 targets, today's price is a massive discount.
This is such a fascinating case study because it really highlights the tension between two different ways of looking at a company.
Absolutely.
On one hand, you have the value or safety view. This investor looks at the burn rate, the miss expectations, and the losses and screams, "Danger! Stay away!"
And they aren't wrong to scream. The risk is real.
But on the other hand, you have the growth or macro view. This view sees a company with superior technology, zinc, over lithium, in a market that is absolutely desperate for product due to the AI boom, growing revenue at 600%.
And the market, right now, is punishing the short-term miss while potentially blinding itself to that long-term macro shift. Wall Street is notorious for being short-sighted. They live quarter to quarter.
And building a manufacturing giant takes years.
It really does.
So what does this all mean? EOS is in that awkward teenage phase. They are growing fast, eating everything in the fridge, burning cash, but haven't yet matured into a profitable adult. It's messy, it's expensive, but it's necessary if you want to grow up.
That's a great analogy. And you have to decide if this is a falling knife, something that's going to keep dropping until it hits zero because they run out of cash, or a discounted opportunity where you can buy a future giant for pennies on the dollar.
It comes down to your timeline. If you need the stock to go up next week, the volatility might kill you. If you are looking at 2030 and you believe in the shift to non-lithium storage, the math looks very different.
It really does.
This leaves us with a provocative final thought to mull over. We live in a world rushing toward AI. We hear about energy insecurity every day. We know we need more storage.
And we know we want it made in America, and we want it to not catch fire.
Exactly. So does the safety and domestic nature of zinc halide storage outweigh the terrifying upfront cost of building the factories to produce it?
Is the market wrong about the timeline? Or is the company wrong about the cost?
That is the multi-million-dollar, or I guess in this case, the multi-billion-dollar question. EOS Energy, EOSE. Definitely one to keep on your radar, whether you are buying or just watching the fireworks from a safe distance.
It's going to be a wild ride to 2026, that is for sure.
Thanks for diving in with us. We'll catch you on the next deep dive.
Don't forget to like, share, and subscribe for more.